Chapter 1: The Retail Trap. The Misconception. Welcome to Episode 4. Everything we've done until now was preparation. Profit told us what the company earned. The balance sheet told us what resources it used. The cash flow statement told us whether those profits actually became cash. Financial statements tell us what happened. But surviving is not enough to generate institutional wealth. Now we combine all three statements to answer the ultimate question: how well did it happen? How efficiently does management convert capital into returns? The greatest trap retail investors fall into is worshiping absolute size. They read a headline that a company generated 500 crore rupees in net profit and immediately assume it is a phenomenal business. But they fail to ask the critical question: how much capital did management have to deploy to generate that 500 crore? If a company generates 500 crore in profit but requires 10,000 crore of capital to do it, they are generating a 5% return. You could earn a safer, higher yield leaving your money in a standard government bond. Absolute profit means nothing without context. Ratios provide that context. To separate a mediocre commodity business from an elite, compounding monopoly, you must stop looking at the absolute size of the profit and start measuring the efficiency of the engine. Chapter 2: The Institutional Mechanics. The Real Concept. To measure this engine, institutional allocators rely on profitability ratios. These ratios compress hundreds of pages of raw financial data into a handful of measurable indicators. We will focus on the two heaviest hitters: return on capital employed, or ROCE, and return on equity, or ROE. Think of a business as a black box. Money goes in, operations happen, and profit comes out. Return on capital employed measures the operational efficiency of that box. The formula is earnings before interest and taxes, or EBIT, divided by the total capital employed. ROCE tells you how much operating profit the company generates for every single rupee of long-term operating capital employed in the business, making it largely independent of how management chose to finance the business. It evaluates the core business model itself. Return on equity, conversely, measures the return ultimately earned by the shareholders after the effects of financing decisions. The formula is net profit after tax divided by shareholders' equity. It is a critical metric, but you must remember that aggressive debt leverage can dramatically inflate ROE. Chapter 3: The Surgical Audit. How to read it. Let's maintain our audit protocol and execute an efficiency extraction on Amara Raja Batteries. First, we isolate their core operating profit, or EBIT. We pull their profit before tax from the P&L and add back the finance costs to arrive at 5,373.88 million rupees. Next, we drop to the balance sheet to identify the company's capital employed. To do so, simply subtract all current liabilities from the total assets to arrive at 15,057.38 million rupees. Conversely, you can also take the shareholders' funds and add all non-current liabilities to arrive at the same figure. When you divide Amara Raja's EBIT by their capital employed, you extract a staggering ROCE of roughly 35%. How does a business achieve this? A brilliant ROCE does not happen by accident. It is primarily driven by two distinct levers: operating margins and capital turnover. Operating margin measures how much profit you keep from every sale. Capital turnover measures how much revenue the business generates from the capital employed in its operations. Imagine two different businesses. Business A is a luxury jewelry brand. They sell a low volume of products, so their turnover is very low. However, they command massive pricing power, meaning their profit margin on every diamond sold is incredibly high. Business B is a discount grocery supermarket. Their profit margin on a loaf of bread is razor thin. perhaps only 2%, but they spin their inventory and capital employed at lightning speed. Their turnover is massive. Both the jeweler and the supermarket can achieve a world-class return on capital, but they do it using entirely different structural engines. When you audit a company like Amara Raja, you must verify which lever management is pulling. Are they creating returns through premium pricing and high margins, or through high volume and rapid capital turnover? Next, we look at the ROE. We find the related PAT from the P&L statement, sitting at 3,674.36 million rupees, dividing by shareholders' equity, sitting at 13,627.01 million rupees, we arrive at a healthy ROE of roughly 27%. Chapter 4. The Weaponised Application, Red Flags and Trade-offs. Now let us weaponize these metrics to locate the most elusive asset in the financial markets, the corporate moat. Capitalism is brutal. Economic theory suggests that if a company is generating a massive return on capital employed, competitors should eventually enter that industry/prices and drive returns down. This is financial gravity. If you find a company that has maintained high returns on capital for a decade, they are defying gravity. It strongly suggests that they possess a structural moat, whether it is an impenetrable brand, a low-cost monopoly, or locked-in switching costs that prevent competitors from stealing their margins. But what defines a high return? There is no universal answer. Asset-light software firms naturally produce much higher numerical returns than heavy steel manufacturers or utilities. The most important question is whether a company consistently earns returns safely above its own cost of capital and above its industry average. Finally, you must be ruthless in your cross-verification. Compare the return on equity directly against the return on capital employed. If a company reports a spectacular ROE of 25%, but their ROCE is a miserable 6%, it warrants immediate investigation. It usually means the core business is highly inefficient, and management is using dangerous amounts of external debt leverage to artificially pump up the returns for shareholders. When the credit cycle turns and interest rates spike, that leverage can severely damage shareholder returns. Demand consistent returns on capital, verify the moat, and never confuse size with quality.